What's up, everyone? So I just listed a few things we could talk about. I like to just do a recap of the market the past week. So it's another bullish week. It's just crazy, right? So all major indexes are at all-time high, and it's just like how high can it get? Are we overvalued? Is there going to be a pullback? We've been saying it for a long time, but who knows? Utilities led the charge, up 3.4% for the past week. Real estate 3%, and then financials 2.4%. Financials are doing really well. If you're looking for a lot of upside, I think in the next few months, I think financials are the way to go. The big banks, because as interest rates kind of stay low, it seems like the banks are able to kind of adjust better and put up strong numbers. At least their financials seem to be going up well. The two negative sectors in the past week, energy, that's the big negative. I think it was down like 2.5% for the week, and healthcare down, I think maybe 50 basis points. I've noticed that when my normal stocks, when I say normal, I mean like my tech stocks, the big stocks, when those go up, my healthcare, like my Johnson and Johnson, and I have Pfizer, do poorly. So it's almost like I'm happy I had Johnson & Johnson, Pfizer when we were in a really bearish market, because those were doing okay. They were actually, I don't even think they were down. They might have been up like 2 or 3%, while like my tech stocks were down like 50%. But now tech is going through the roof and the healthcare is going down. So I guess it's like, you could think of healthcare kind of like gold. You just, if you need to hedge your portfolio, it seems like the way to go. At least that's what I've noticed. Maybe it's just my particular stocks in the healthcare industry. So I have just some notes I wanted to go over, but feel free to leave a comment. So Dow is 43,275. Crazy. It's over 40,000. S&P is closing in on 6,000 at 58.64 to close the week, and the NASDAQ 18,489. Those are the three indexes. When you want to follow the market, or when someone says the index or the main index, it's really the Dow, the S&P, and the NASDAQ. Those are the three main indexes. Another index that's somewhat popular is the Russell 2000, which is small cap stocks. And that has been lagging the market. And people have been saying small caps is the way to go, but in the long run, I don't think so. Small caps are that good of investment. At least I'm a big fan of the large caps. But it's been a 3-year bull market, 22, 23, and 24. Market just keeps sky high. And this is an education channel, so throw in some little education. I'm sure you guys know this already, but I'll just I'll say it anyway. So the Dow, let me get the settings. I hate grid lines. I hate seeing grid lines. Doesn't make sense, I know, but so the Dow, when you hear the Dow, it's not the best. It used to be the best indicator. It used to be kind of the holy grail, but I think the S&P 500 is a better indicator. But the Dow is 30 stocks. So these 30 stocks dictate the value of a big market, which doesn't sound like it makes much sense, but that's how they've always been doing it. So these are 30 stocks in the Dow. So Amazon is, I guess, the biggest one, right? Oh, Microsoft's here. Microsoft and Amazon and Apple. Apple's here too. So really big stocks. It has some stocks that are not so great. Boeing is kind of coming down a bit. You don't have NVIDIA in here, but these are the 30 stocks that make up the Dow, in case you were curious. And here's some more market info. So if you're one of those people that says, I'm not buying, it's a bear market and I'm just throwing money away, just look at the earnings multiples. So it's a little overvalued, and I do agree with you there. We're trading at a 20 times PE, at least the Dow is. S&P even worse, 22. And NASDAQ 100, which are the 100 large cap stocks, that's trading at a 26 times multiple. So the 10-year average, if you're looking at past 10 years, it's more attractive. So I guess if in theory, yes, the market is overvalued if you look at this. But the earnings are strong. Companies are constantly coming in with stronger and stronger earnings. So either earnings will come up to bring this multiple down, or the stock market will come down to bring the multiple down. One of the two will happen, or both. I see earnings continuing rising, so I'm sticking with my stocks. I'm not jumping ship. I guess if I was retiring within the next 2 to 3 years, then I would consider maybe trimming down. I'm not sure if I would actually, but maybe I would consider that. But at this point, I don't see that much of a risk. So let me see. So here's an interesting thing that I just heard from Tom Lee. Yeah. So Tom Lee, he's really popular on those on Bloomberg and those news sites. So it's come on. So since 1999, so 25 years, there's a 6-month window where the real estate market beats the S&P by 19%. He says, like, and he's not exactly sure why, but since 1999, like 80% of the time, between October 20th and April 29th, the home builders have beat the S&P 500 by 19%. So that's something to consider. So if you're looking to adjust your portfolio, sell some stocks off, or you're looking for something to invest in, that might be a good choice. Home builders. So between now and April 29th, home builders generally beat the S&P 500 by 19%. That's a pretty good number. And home builders, it's kind of like a lot of people, especially people who don't have a ton of extra money in savings, their main net worth is their home. If you own a home. A lot of people who are millionaires because of their home. It's not because they saved $1 million in cash or they invested $1 million in the stock market. It's generally from their home. So that's where a lot of money is tied up. And that kind of segues me into China. So China, they're really trying to revive the real estate market, because that's really the main market. Most people in China who are well off are in that situation because of their home. The stock market is not nearly as popular in China as it is in the U.S. A lot of people in China actually don't trust the stock market. Real estate is real big, and especially if you don't have a lot of money. If you're making just a little extra money a year, you're generally going to use that to get a home or to improve where you live. So that's why it's kind of a big deal in China that they revive this market, because without the real estate market, they're kind of dead in the water. So and it's government run, as you know, China. So they're injecting 562 billion. That's a U.S. dollar. So if you want to convert that to yuan, it's like 3.5 trillion yuan. But 560 billion U.S. dollars they're injecting into the real estate market to complete unfinished homes. There's like millions of homes that haven't gotten completed just because of companies going bankrupt, The government not able to support those companies. And so on the government's plan, and this was they just had a meeting. They just had an announcement. So if you want to watch any of the news channels, you'll see the same tidbits I'm mentioning. But they're going to renovate 1 million homes in depressed or urban areas, because a lot of people in China who got to that middle class level have put down payments for homes, and a lot of those homes are just sitting there because the companies they gave money to don't have the funds. Either they went bankrupt, those companies, and a lot of it is government controlled. So the government kind of controls pretty much everything. So they're trying to get things back on track because it's been a depressed real estate market in China for 3 years now. Let me just check. And you might think, well, I don't know if you're in the U.S. A lot of people I know watch my channel in the U.S. But regardless of where you are, whether it's the U.S. or in the U.K. or Canada, the Chinese market has a lot of influence over the rest of the world. Just like the U.S. market, China is the second biggest economy. Because when you have so many people looking to buy a new home or to upgrade, that creates a lot of need in China, a lot of need for materials, right? For products in order to build homes, and a lot of labor, and there's a lot of money that's going that could be going to China to get those products. The lower interest rates have helped spur this growth, and I know China is not huge on capitalism, like helping companies become hundreds of billions of dollars, worth hundreds of billions of dollars. They're not big on that, but they are big on real estate, and they are big on maintaining, keeping money in house. But yeah, let me know if you have any comments on this. But these are just kind of tidbits. NVIDIA again reached all-time high. BofA gave them a target of 190. So it's still people really bullish NVIDIA, and I keep saying, "Oh, I should have invested in NVIDIA," and it keeps going up. I'm like, why don't I invest? I guess I kind of feel it's too late, but I probably should still, because I think there's a lot of upside. And what's really helping, I'm going to show you this kind of new thing I did. I just did a semiconductor video. But Taiwan Semi reported really strong results. And there's a lot of demand. There's a lot of need. And when Taiwan Semi gives a good forecast, that kind of says, it's kind of saying the semiconductor industry has a lot of demand, because Taiwan Semi is the company that makes the semiconductor chips for their biggest customers, NVIDIA, but they make it for Broadcom. They make semiconductor chips for a lot of companies. So if there's a lot of demand with Taiwan Semiconductor, that implies a lot of demand at NVIDIA as well. And Taiwan went up a lot, right? It went up like, I think 10% the other day when they reported. So if you're a little concerned about NVIDIA because it's so expensive, I think that's a good play. That's a good alternative, Taiwan Semiconductor. Because if NVIDIA does well, Taiwan has to do well. And if NVIDIA struggles, that doesn't mean Taiwan will struggle, as long as the other semiconductor companies need help from Taiwan to manufacture chips. Trump 2024, yes, I hope so. Just for the market purposes, he's good for the market. And if you're looking for an alternative to Taiwan Semiconductor, to NVIDIA, the Dutch company ASML. So ASML doesn't manufacture semiconductor chips. They're not a foundry. They're not fabless. They're not even on this list of semiconductor companies. So there is confusion. What does ASML do? How are they involved in semiconductor chips? Well, they manufacture the equipment that companies like Taiwan Semiconductor uses to make chips. You know, and there's a lot of companies. Intel makes chips. They also design as well. So what ASML does is they design and manufacture the lithography machines. And that's really an essential part. It's kind of like if you're Coca-Cola, just because you make the actual soda, the soft drink, you can't make it unless you have the company that supplies the manufacturing to you. Unless it's like, 100 years ago and you don't make much, but in order to make products, you need the machinery to do it. And that's what ASML does. They just provide the machinery, the equipment, in order for these foundries to make the semiconductor chips. And semiconductor chips are very complex to make, so it's not like you're going to see that much competition with ASML. Let me know do you follow semiconductor companies? Because it's a really interesting industry, and I kind of regret not putting more money into it, and it kills me. But I'm invested in the S&P 500, and I'm sure a lot of people here own indexes. You might own S&P 500, like me. You might own the QQQ. You might own the NASDAQ 100. Whatever you own, the fact that companies like NVIDIA are doing so well is helping our portfolio indirectly. We might not own, if you don't own NVIDIA directly, indirectly you have to own it, assuming you own any index. And even if you don't own an index, I noticed I own a lot of Meta. I noticed when NVIDIA goes up a lot in one day, because I have like a list of tickers that I open up on Yahoo Finance, and NVIDIA is like one of the higher ones up. I'm not sure why, and Meta is on the bottom. And I see NVIDIA is up like 3-4%. And then I'm scrolling, and almost always Meta does well when NVIDIA does well. And Meta goes down when NVIDIA goes down. So it's bringing up the market. So don't hate on NVIDIA too much. It's kind of like those people who said when Trump got elected, I hope he fails and I hope he screws everything up. It's kind of like saying, I hope my life is ruined and he ruins our economy to make me feel better about him being president. You hope harm to yourself, which doesn't make sense, right? Why would you hope the president does poorly? That will affect you, right? So it's kind of like that with NVIDIA, if that makes any sense. I think it does. So I'm just trying to hit on some key notes before I get into like the deep dive stuff. So the prediction is still a year-end rally. Like market is still going to stay strong up through the end of this year. There's no signs of weakening, and it doesn't seem like it matters what president, who gets elected. Of course, if Trump gets elected, it's going to help the stock market a lot more than Harris, because Trump tends to be pro-economics, pro-growth, pro-business. So he's more interested in like things like lowering taxes, which helps companies borrow more. Because if you're a business, whether you're a small business with just 20,000 in the bank, or you're a massive business with 20 billion in the bank, doesn't matter. If you need financing, if you need a loan, if you want to scale, you have to pay a high interest rate, theoretically, if interest rates are high, which is expensive. So not many people can do that. If interest rates are like 7, 8, 9%, you can't get a $100,000 loan. You just can't afford the interest payments. But if interest rates are real low, 2, 3%, like they were 6, 7 years ago, it's just easier to get a loan and it's easier to grow your business. So, and Trump, that's kind of like his thing, growing the economy. So he lowers interest rates. He's big on deregulation, And a lot of people just focus on the negatives, but he did a lot when he was president. Job growth was real, jobs, like, I think that's when it started. Like, we were, unemployment was kind of high before him. Then when he got in office, it seemed like unemployment got to really low levels. And I know a lot of people say, well, the reason it did well when he was in office is because the president before him set it up. So it doesn't matter. I don't care what people say. As long as the economy's strong, I don't care who's in the White House. As long as I'm making money, I'm happy. I don't know if any other ideas. So I was going to touch on, those are like the main notes. I was going to touch on Netflix, because I was so bullish Netflix, and I picked up a lot of Netflix at around 350, and it came down a lot. I was down 50% at one point. This was in 2021, I think I bought it. I put a good chunk into Netflix when it was like set. I'll show you the chart. It's probably easier to. I mean, I really wanted to buy Netflix in 2010, 2011, when I used to get that red CD in the mail, but I didn't pull the trigger. And then it was over 700. I hate the way Yahoo Finance does it now. It makes it harder to. I'll just use. I can't use Yahoo Finance anymore. It doesn't work. Okay. Well, this works. Okay, so the thing with investing is, even if you're like brilliant at predicting stocks, if you don't have any money, like if you're in high school or college, it doesn't really help you, right? You're probably not going to be able to get a loan either. Maybe your parents would lend you $500 or $1,000, but anyways, so I really wanted to buy Netflix, but that's when I started my business in 2012. So I kind of held off, and then it got to like 670 at the end of 2021. I'm like, oh God, I'm so stupid. It's so high. It's ever going to be a pullback. And then I picked it up at like 380 because it was down almost 50%. And then right away, within 3 months, I'm down 50% on my 380. It's down to 190 or 180. Of course, I wish I bought more. And hey, Byron, Bulldog, what's up? We should do a live stream. I don't know if you're ever interested in that, but so I put a bunch in here. I'm up 100% now, just about, on this. So I can't really, but we're never happy, right? I got a 388, so almost 100%. But we're never happy. I'm up 100% in 2.5 years, which is great. But I'm pissed off that I didn't DCA and pick up more when it fell down. But you don't have infinite money, so you just got to kind of, I guess, be happy for what you get. And I mean, I knew it was a huge. I was real bullish, and I didn't realize it was going to go up this much. But just the market is just going crazy. So now it hit its all-time high. It went up like 12%, right? Would you buy Meta? I just bought Meta yesterday. That's how I do it. My investment strategy is, I pretty much buy and hold, right? And I'm getting close to 40,000 subs, so I could finally do a portfolio reveal. It's been over a year, because every 10,000 subs, I do a video showing my portfolio. I finally broke 39,000. But my last video was over a year ago. I don't know what's going on, but for a good 6-7 months, I was only getting like maybe 3 or 4 subs a day. And I had days like this. You see October 11th, -5. But the past week, I don't know why, but the past week I've been getting a lot of subs. Like 39 on one day, 36, 38 yesterday. So hopefully I get to 40,000. So yeah, so that's my strategy. I buy and hold long term. Sometimes I sell if I lose faith in the company. But I get dividends on some stocks. Now I get dividends on Meta. Sometimes, so when my dividends grow every maybe month, I look at my account and I usually have like whatever it is, 1,000, 2,000 in dividends, and then I use that money to buy stock in certain companies. Like in my wife's account, for the past year, I've been using all her excess funds, her dividends. She puts $500 a month in also, so to buy Microsoft, and that was going well, but now it's coming back down. So I usually pick a stock. So for a year, I just buy that stock or something like that. So I did it for Meta. My portfolio has Meta. Sometimes I do it for S&P 500. So yeah, so yesterday I bought Meta. I hope my portfolio doesn't go down by the time I hit 40,000, but we'll see what happens. So it's crushing it, Netflix. And did I have any other notes on Netflix? Yeah, so they created the perfect kind of like model. Is they spend more than anybody else, and it's really, really expensive to acquire content because certain TV shows and movies, not many people watch, so it doesn't cost that much for Netflix to acquire content. But when you buy a TV series like Seinfeld, which I watch all the time on Netflix, or Friends, or you buy a popular movie, it's really expensive. I think like Seinfeld alone probably cost Netflix $500 million. Just that one show to be able to watch, to be able to let people watch it. And they have so many shows. Like it's just like you couldn't even watch if you spent a year watching Netflix. You come nowhere close to watching everything they have. So they spend more than anybody else on content, which is what you need to do. And then of course it gets people interested in it, because when there's like a new series, like a really popular new, and they have a lot on Netflix, like just I can't stand this fucking font. The Menendez Brothers, that's like the newest one. I started watching that, then I kind of lost interest. But there's always like the Dahmer had that, with a 3-part or 4-part, which I thought was really good. What's that one where there's 100 people? It's in Taiwan, is it? There's 100 people, it's like the Hunger Games. People die, and there's one person left alive at the end and gets $1 million. It's not obviously real, but that was really popular. What's that called? You can do Jerry Seinfeld impression. I've been told that, I think. What's that thing on I just saw Seinfeld 2 weeks ago, live stand-up comedy. So it just, when they have these like really catchy, and then usually not even movies, they're usually like these mini series, like these it's usually like 4 or 5 episodes, and it's really, really popular. Like, and so many people watch it. Squid Game, of course. Like people watch Squid Game and they talk about it at work. And then people who don't have Netflix are really encouraged to get it because they want to be part of it. They have so many of those types of things. And then they have so many users, so many subscribers, and then they raise prices. and that's how they're growing. I mean, they're making more money than ever. And did you know half of the new subscribers on Netflix are at the advertising level? Because when Netflix first came out, they said, we will not show advertisements. There won't be any commercials. The way we make money is like you pay us. And in the beginning, it was real cheap. It was like $7 a month. And you get on this monthly plan. You can watch whatever you want. So that's how they made money to pay the bills and pay for content, is the money each subscriber paid. But I think, what is it, like 2 years ago, they added the advertising model because, demand was getting rougher. So instead of like $20 a month for streaming, I don't know what they charge. They're probably like $10. So you're $10 a month, and then you just have to watch commercials. So about half the people who subscribe to Netflix are at the commercial level, which is really interesting. So they're getting a lot of people who normally wouldn't have signed up for Netflix because it's too expensive. Some people can't justify paying $20 a month or whatever they charge, so they get the cheaper option. And once people are in Netflix, once they're subscribers, it's hard for them to stop, because even I've gone months without watching Netflix for whatever reason, but I'm not going to cancel Netflix because it's just not that much money. If I was paying like $150 for a gym membership, I might cancel that because that's a lot to pay for not going. But if I don't watch Netflix, or maybe watch one movie in a month, I'm not going to cancel it. They're investing more into live content, especially sporting events, because sporting events really have to be live. So they're really capitalizing on a lot of not just the main sports like football, but like UFC and boxing and soccer. I mean, who wants to watch soccer? It's so boring. But if you don't live in the U.S., that's probably your sport. So I think in this quarter alone, they added 5 million subscribers. Victor, what's up? Culinary Wars. Yeah, I like a lot of those shows. So this is the top. So Netflix is still number one, 278 million. And they have a lot of room because it's not like I worry a little bit about Meta, because like half the world uses Meta. So you can't really, once you get like the whole world using your product, what can you do? I guess you can raise prices, but you can't get more people because you ran out of people. Maybe the aliens, maybe there's like 100 billion aliens in another galaxy that we can, like Bezos or Elon Musk can help us get in contact with, so they can start paying for Facebook or Instagram. So anyways, so 278 million, which isn't a lot. That's not even the population of the US. So there's still a lot of room. Amazon Prime is real big because it's just Amazon, and it's already had a pretty big market share before they came out with this. And I invested in Disney because I thought Disney streaming, I didn't think it could be as good as Netflix, but the really big benefit of Disney is that a lot of the content they don't need to pay for because they own it already, which is a big benefit, because Netflix, they don't really own. Now they started making their own content. So they do own some, but Disney owns quite a bit of content because they've been around a long time, and their portfolio is pretty significant. And then you see the Chinese companies, Tencent and Ichi. I think that's how you pronounce it, Ichi. I also have Hulu, and I do like Hulu. I rarely use it, and I have the advertising plan. So I think it's like $120 for a year, but I have to watch commercials. But I don't use it that much. But I like having the option. But they all keep raising prices. But I mean, it's really so cheap because just to go to a movie, if my wife and I go to a movie, that alone, just that one movie, is the whole month of Netflix. Because it costs what, like $12 for a movie, $24 for the two of us. That's like a month of Netflix. And with Netflix, you can watch unlimited amount of movies and TV shows. So who's the next? Who's the next streaming service that can compete with one of these big guys? I don't know. I don't know if there's anybody, at least that I can identify. But these things, it's kind of like before a company becomes really big, it's hard to identify. But it could be one of these companies. I'm not even that familiar with iFlix. I don't think I've ever heard of that. CuriosityStream, ESPN, of course I know. A lot of these streaming services are connected to a channel like HBO Max, Paramount, or a group of channels. So I think there's a little less growth potential, because if you're ESPN, you're not going to be producing or acquiring content for like the Hunger Games movie or Seinfeld. You're not going to do that. It doesn't make any sense. So people wouldn't pay for ESPN unless they really like sports. If someone really likes watching soap operas, they're not going to go to ESPN streaming. But it's kind of like, it's like the low-hanging fruit for ESPN. You might as well offer that streaming service because you just could, it's just another way to monetize your brand. So I think there's a lot of upside with China. So I would consider buying I forgot what the name of the Chinese index is, but yeah, I would consider. So I wanted to go through Netflix's earnings. I just did a video on Walgreens, and I plan to do a video on Paychex, because I'm pretty familiar with Paychex, but I've never done a video on them. I don't think it's going to get that many views, and I like to pick some lesser known companies. So AZZ is definitely, I never even heard of this company until I saw they released earnings. And they do galvanizing and coating for metal. But it's kind of I'm trying to think. So we'll talk about Netflix earnings. There was something else I just thought of, I forgot what it was. Damn, I can't remember now. Oh, this is. So I'm doing this is just a new idea for a video. So I'm going to just take an industry, and this, I'm sure you're familiar with this chart. Damn it. So the left part of the blue line is kind of like, is a chart I always, you see in most of my videos. So if I did a semiconductor video on a semiconductor company, I would show this chart. It's the top 20 semiconductor companies. There's actually 64. I just have the top 20. And then I show these columns, all the price multiples, the market cap, kind of like the popular things to compare the 20 companies. So I just did a video and pretty much all I do for the whole video, like it starts off blank, like nothing's in these boxes to start. And then I go to Simply Wall Street and I go through each company. So NVIDIA, I show in the past year how they performed, which is freaking crazy, up 233%. Then I show the current stock price, what Simply Wall Street's valuation of the stock is. See, Simply Wall Street target is 92. So Simply Wall Street, so it's up 233% in the past year. And Simply Wall Street's target is $92. So they say they're overvalued by 50%. And then I show the analyst prediction is 150. So that's the analyst projection, and there's 52 analysts. So I just do this for all 20 stocks. So Simply Wall Street says NVIDIA is 50% overvalued. Analysts say they're 9% undervalued. And I also show how many analysts and the insider shares sold and the insider shares purchased. I do this for all 20 companies, and I kind of talk about it as I do it. And then at the end, we see who performed the best and worst in each category. NVIDIA did the best. Intel did the worst. They are down 35% the past year. And so as a whole, Simply Wall Street thinks this industry is only 3% undervalued. The semiconductor industry, that's the average for all the 20 companies. Simply Wall Street thinks it'll go up 3%, the semiconductor industry. And the analysts think it'll go up 22%. So ST Microelectronics is the most undervalued according to Simply Wall Street. And Global Foundries is the most undervalued according to analysts. When I usually try these different things, I usually don't get that many views, but I don't know. I always try to try anything. Okay, so let's talk about Netflix. I don't know if anybody has any thoughts on that. So Netflix, they just released earnings just on Thursday, October 17th. So revenue, $10 billion for the quarter. Oh, that's a forecast, sorry. $9.8 billion. That's the quarter they just released. The forecast for next quarter is $10.1 billion. So that's up. It was 8.5 last year. Now it's 9.8. So that's about what, 11 to 12%? 15%. Doesn't look like 15%, but I guess that's what it is. That's what it is. Oh, it's right here, 15%. So yeah, it's up 15% from Q3 2023, which is worse than last quarter. They improved 17%. But you generally don't want to compare quarter over quarter. You want to compare to the same period last year. Because when you compare like Q3, you can't compare it to Q2. It's just different times. And most businesses are cyclical in some sense, especially the fourth quarter is a really heavy quarter for most businesses for the holidays. Operating income, almost $3 billion. And not only is revenue going up, I mean, it's going up nicely. I mean, 15% is a pretty good growth for a company, $8.5 billion of revenue for the quarter. So 15% from that is a nice growth. I think you would agree. But their margins are going up so much more because their expenses are going up at a lower rate. So look at their margins are up to 30% operating margin. It was 22% last year. It's hard to be so profitable, especially when things get more expensive. But they're doing a great job. And that's why the stock is going up a lot. Because sometimes when a company's revenue increases, sometimes you see actually the stock price go down. Or sometimes when a company's revenue decreases, the stock price goes up. Because a lot of it is margin. You can I'll show you an example. Like I'm sure you guys know this, but sometimes it's just good to hear it. Like if you have revenue of $1 million, and so like 2023, you had a revenue of $1 million, your competitor had a revenue of $1 million, and you both had good margins at 30%. And let's say in 2024, your revenue doesn't grow as much as your competitor. You grew 20%. Okay. Neil, what's up? Baba is not a rubbish stock. So in 2023, say you and your competitor, you both had $1 million of revenue each, and you both had the same margin, 30%. So profits for both companies were $300,000. But let's say in 2024, you grew your revenue 20%, so you went to 1.2 million of revenue. You still maintain a 30% margin, right? So your profit is 360. Your competitor tried to grow revenue more aggressively than you. So they didn't like, you kept it with the kind of the plain vanilla business model that you usually have, but your competitor wanted more revenue. So they went out and it just cost them more money. They had to pay more in like payroll. Maybe their sales team had to pay more money. Maybe it was just, there was more problems trying to make the product, whatever it might be. But in order to aggressively grow their revenue, and they only grew at 100,000 more than you did, they sacrificed profit for higher revenue. So their margins went down to 20% because it was just more expensive to get these customers on board, etc. So you could see like how margin, it could really make or break a business. Some companies, here's a perfect example of how Walgreens, like Walgreens Food Alliance. Look how much they generate almost more revenue than like 99.9% of the companies out there. Like 150 billion of revenue. In 2022, they had 130 billion of revenue. It's a ton of revenue. I mean, Netflix isn't even close to $130 billion for the year. But look at their profit, $4 billion. I mean, it's not much profit there. Very slim margins. And look what happened. The revenue grew the next 2 years up to almost 150 billion, but they're losing money. So who needs a business where you're losing money? I could give you a business idea, and I guarantee you can get $1 trillion of revenue. You could have the most revenue out of any company in the world. I'll give you the business, and it's not hard to do. Anybody can do the business. You don't need any specialized skills, and you get all the sales in the world. Everybody would be your customer. Does anybody want to know the business? It's simple business. All you do is you're the $100 bill company. You sell $100 bills, and you sell it for $90. So that's the business model. If anybody wants, they go, can I get a $100 bill? Here's $90, and you give them a $100 bill. So you get your sales would be as much as you want. You get trillions and trillions of dollars in sales, but your market cap wouldn't be that high. You have the best price sales ratio out of anybody in the world because your price sales is market cap or revenue. Your revenue would be like nearly infinite, right? So it would make your price sales look extremely attractive. Like you'd have like 0.001 price sales ratio. So, I mean, you can only sacrifice revenues. You can only sacrifice profits so long before you have to start making money. And that's what a lot of companies do. And it's hard for us to figure out. Like, they just want to increase revenue, and they don't care if they're losing money year after year. I mean, how do you identify it? Like, Amazon was like that for like 15 years. They lost so much money. And people were saying, this is junk. It's never going to make any money. They never make any money. Their revenue grows a lot year after year. but you have to just trust the business plan comes to fruition. It works out. But there are plenty of companies that just, and I've consulted with a lot of companies like this. They just care about revenue, and they don't care about profit. I mean, if you guys watch the channel, you probably understand what I mean by that. And some people who don't understand how businesses work, they don't get that. Like I would say, like having 100 million of revenue doesn't mean you're a great business person, and having 50,000 in annual revenue doesn't mean you're a terrible business person. Because if you're 100 million in revenue and you lost 100 million dollars, like your expenses are 200 million, you're not that good of a business person. Maybe you will one day, but at this point, it's unless you show me a plan where you're going to get profitable. But if you make 50K in revenue and your profits are 50K, meaning you have zero expenses, you did it all yourself, you might be running a good business. Assuming you could live on 50K, which is kind of hard to do, right? But I wish I would have just stuck with my guns for the longest time. If anybody said, what stocks are you bullish in? I would always say Meta and Costco. Those are my two stocks. I should have just kept with what I understood. I shouldn't have put money into all these other investments. I could have been up so much more, but I guess hindsight's 2020, right? 600 million members and growing. So that chart we looked at earlier, 277 million. I think this is just people who pay. Who pay on, maybe it's an old chart. I thought it was new. I don't know how they got 600 million, because I know they try to eliminate password sharing, because a lot of people were sharing passwords. So they eliminated probably 100 million people, and a lot of them end up paying, maybe half of them. No best to keep moving. Squid Games 2. I'm looking forward to that. It's kind of like they created this Netflix created this thing where it's kind of like you have to have Netflix in order to be connected to all these interesting shows. Without it, you're kind of missing out. And if that wasn't the case 5 years ago, it's definitely the case now, because there's a lot of shows Netflix has that you can't see anywhere else. I wish to give a breakdown of the members. They probably do somewhere. So here's just a breakdown by location. So 4.3 billion in UCAN, US and Canada, I guess. EMEA, 3.1 billion. Europe, Middle East, Africa, Latin America, 1.2 billion. APAC, Asia Pacific, 1.1 billion. But the average, this is where margins come. Average revenue per member, $17 in UCAN. Because most of the people who are members in US and Canada are paying full price. And then you see it's $11 EMEA. Yeah, $11 EMEA, $8.40 in Latin America. Asia Pacific is the cheapest because a lot of people are using the advertising membership, which is lower. I didn't even think they had a level at $7.31. Growth is 5% in US, Canada. It's flat in EMEA. It's actually down, and it's down in other countries, which is a little concerning, right? Okay, here's the paid memberships. So they have 85 million members in US and Canada, but they have more in EMEA, 96 million. But more people in EMEA who are paid members are paying at the lower tier, the ones with commercials. So they only added 690,000 members in Q3. They added 2 million EMEA. They lost members in Latin America. APAC is the big growth. They've been growing there a lot. They added 2.28 million members. So how did they get to 700? So how did they get to 700 million? Didn't they say was 600 million members? Our members rely on Netflix and tame them with an audience 600 million growing. 600 million. I wonder how they got to that number. Maybe I need to get their full 10K. 600 million. Because this is 85 and just pretends 100. So 185 plus 50, 235, right? Plus another 50, 285. So 285 million paid members. So they say 600 million. I wonder how they get 600 million. Maybe any ideas how they so streaming revenue 4.3 billion. They added 700 million members, which is a lot less than last year. Last year was 1.8 billion. So the number of paid members is 85 million. Oh, this is what we just looked at. So how do they get to 600 million? Just buy an ounce of gold. They must have a paid net members. I got to figure this out. Why do they write 700 million? I keep saying 600 million. Maybe they're saying with an audience of 600 million, that's not their members. That's just the potential audience. But even that doesn't make sense to me. They might have a lot of free members. I don't know. We are the leading 283 paid members, 190 countries. Members can play, pause. I guess do they have a plan where you don't pay anything? I don't think so. So they have paid plans from $1 to $33 per month. $1. I wonder what plan that is for $1 a month. $600 million. I don't think I got to figure this out. Yeah, I don't know what they mean by that. Engagement and content. Our members rely on Netflix to entertain them, and we want to be the first place for entertainment. With an audience of 600 million growing, I guess that's the potential. But it doesn't make sense because the US alone is almost 400 million people. I guess there's 600 million adults who they can stream to. 600 million people who own a TV. Adults with a TV. It's why we invest in a wide variety of TV shows and films. I don't know. I don't really understand what 600 million is from. Yeah, I did a video on Walgreens. I could show you how simply Wall Street calculates their they do their DCF, discounted cash flow model. This might be a little. Okay, so here's discount DCF 101. Okay, so I'll go through like how I calculate my DCF. So what is a DCF? What's the purpose of a DCF? You're trying to value an asset, whether it's a stock or a piece of real estate or a business or an investment. It could be if you buy an apartment, right, for like a couple $100,000. It is easier to kind of like talk about DCF in those terms because it gets a little complex with a stock because there's a lot of moving parts and people like. So say you buy a apartment as an investment. Say you already live in a house with your family, but you want to like an investment to make money, possibly build equity. So you buy an apartment for $200,000. You buy an apartment for $200,000, and then you want to run a DCF to see how much money you can make from the apartment. So you need to project your future free cash flows. So okay. So how do you project your future cash flows? So it's pretty much you only get one source of income from this investment is the rent the person pays who lives in the apartment. There's no other like income, say, coming in. You don't charge for anything else. So it's $2,000 a month you charge them. So $24,000 is your income. And say you build in a lease, you raise it 6% a year. So year one, year two, year three, expenses, you have to pay taxes, and there might be some other like maintenance. So you let's say you calculate $10,000 in tax in expenses. This is for the year. So that's your annual profit. And you don't want to do this for like, 100 years. You got to just, at some point, you got to assume it's going to have some steady growth. So you just do it for 3 years out. So, but $14,000 you're going to be collecting over the next year. You have to convert that to today's dollars, because you want to identify whether you're willing to spend $200,000 on investment. Then you have to calculate your discount rate, which is probably just how much your mortgage is. Say you pay 6% interest. So if I was going to give you $10,000 a year from now, that's equivalent to $9,400 today. Because if I give you $9,400 today, you have the ability to invest that money and grow it to possibly whatever. It's actually the same exact number all 3 years, because I assumed rent and expenses would grow 6%. Let me change it. Say I'm going to do 8% is the expense growth. Expenses are going to grow a little more. Then I sell your shares at a loss. What are you talking about, Neil? What topic? Okay, so here it is. So if you wanted to buy an apartment for $200,000 and you wanted to project how much money you would generate from that, the way you would do it is you would look at your cash flows, just like a business. And this is a really simplified way to think about the DCF model. So if year one you charge $2,000 for rent each month, you get $24,000 of income, and you project expenses to be $10,000, maybe taxes are $5,000, and then you have like some maintenance, HOA fees. I don't know. Say you paid electricity, you give them free electricity, whatever it is. So your profit for the first year is $9,400. For the second year, it's $9,600. For the third year, it's $9,800. But you're going to be making money after that. So your terminal value would be all the future cash flows. So it's the same concept with a stock. You just project the future free cash flows. I usually use the analyst estimates to do that, and then do a terminal value. and that's based off of the WACC and the discount rate, and that's the value of the so with that in context, so I calculate Walgreens stock at $16, and I'm using the future free cash flows from the estimates, the analyst estimates, and I use a pretty high WACC because I think it's a little risky, the investment. So now I'll show you Simply Wall Street. If you're a member of Simply Wall Street, you can see this as well. So you know how I always show Simply Wall Street's price target is 24. So they say it's much more undervalued than I do. They're at 24. I'm at 16. So how do they come up with 24? They actually give you all the data. This is surprising. They use a high discount rate. It's usually a lot lower. It's usually like 6-7%. But they're using a really high WACC, 10.5%, which is still lower than mine, but it's in line with my discount rate. And they give some more information, and we could talk about this, but I don't want to. It gets a little hard to follow. It's pretty similar to what I do, but what they do is they do a multi-step. It's the model is called a two-stage free cash flow to equity. They have the discount rate on the equity. This is just on the equity only, 10.5%. Then they have the growth rate. That's what you think the cash flows will grow each year after your last year. So in my case, I only project up through 2028 free cash flow, 4 years. And then my terminal value is, I also usually use a 2.5% growth rate for the terminal value. They use it as well. That's the more common type. Because 2.5% is kind of like the risk-free rate, what you can kind of get a guaranteed growth rate. They also have an equity risk premium. This is S&Ps. So if it was a Chinese stock, it would have a really high risk premium, which would raise the WACC a lot. But it's not. The risk premium is based off of what country the company's in, what industry they're in, and some other factors. And then they unlever, they use an unlevered beta, then they relever the beta, and then they lever the beta. That's just leverage. They just unlevered beta is calculating the beta without debt, and levered beta is calculating the beta with debt. And they come up with a WACC, 10.5%, which is pretty close to mine, which is funny because usually it's a lot lower. And then I usually go out 4 years. So I did 2025 free cash flow, 531 million, and I'm using their free cash flows. So that's how I got my 2025 free cash flow. 3 analysts project 531 million. And then you have to present value that. It's 481 million. So I present valued mine, it's 478 million. But one of the big difference between my model and their model is they go out 10 years. See 2025, and it goes up to 2034. So they're going out 10 years of free cash flows. So that's why it grows a lot, because they're projecting free cash flow to grow a lot over the next 10 years. my free cash flow only gets to 1.4 billion by 2028, which is pretty close to what they have. So the sum of the 10 years of free cash flow is 8.6 billion. That's in today's dollars. So the next 10 years of free cash flow for Walgreens is worth 8.6 billion in today's dollars. And then they calculate the terminal value. The way they calculate terminal value is they take the 2034 free cash flows. Actually, no, they take the nominal, the 2.6 billion. They grow that. It's the same way I do it. I take my 2028 and I calculate my terminal value the same exact way. And then you present value the terminal value. So the terminal value, all cash flows past 10 years, is 33 billion. They present value that 12 billion. So 8.6 billion plus 12 billion is the value of the company. Because this is the next 10 years of free cash flows. This is everything beyond 10 years. So about 21 billion is how much the company's worth today. And they divide that by how many shares they have. So that's how they get a stock price of 24. So I say the company's worth 14 billion. They say it's 21 billion. So that's it. That's how. So it's the same way I do it, except they go out more years than I go out. And the WACC is usually different too. But yeah, if anybody was curious about that, I think it hit on everything I was going to talk about. I guess unless there's any unless there's anything else, I guess we'll just end it here because I don't think I have anything else to talk about. Yeah, thanks for joining. I hope I hit 40,000 soon, so I could do a portfolio reveal. Because it's been a while. I know people were asking about it. And I'll, talk to you later. Okay, thanks.